The screen flickers. A chart blinks red and green, numbers shifting before you can blink. Everyone's talking about silver, about the floor at $70. But let me pause right there. That idea, the floor, isn't some law of physics. It's not guaranteed. It's a narrative people repeat. Markets, they don't care what you think. They don't react to what's obvious. Here's what most people overlook. The market moves first where attention isn't focused. Not where the headlines scream, not where your neighbor is buying or selling. It moves in the quiet spaces, in the patterns only visible if you're actually looking, not guessing. Imagine a narrow elevator, not going up, not staying put, but creeping down. Slowly. You don't know how far it'll go until it does. That's silver right now. Not a guarantee, not a collapse, just movement outside the assumptions. The question isn't whether it will rise or fall tomorrow. The question is, what has shifted under the surface that few have noticed? That's the lever. That's the angle you don't hear in a dozen Reddit posts or YouTube clips. By the time the news catches up, the market has already moved, and that's the space we're going to explore. Silver opened the first week of March at approximately $72.10 per ounce, according to data from the London Bullion Market Association, LBMA. Over the next 3 trading days, the price fluctuated within a range of $70.50 to $73.20 per ounce, with intraday movements averaging roughly 1.5%. During this period, trading volume on major U.S. futures exchanges, including COMEX, averaged 42,000 contracts per day, slightly above the 30-day average of 38,500 contracts. Open interest remained steady at 162,000 contracts, reflecting minimal net position changes among institutional participants. Looking at broader commodities, spot gold remained within a $1,950 to $1,980 per ounce range, indicating relative stability alongside silver, while copper and oil prices saw mild increases of 0.8% and 1.2%, respectively, over the same period. In the context of monetary policy, the Federal Reserve released its February Consumer Price Index, CPI, report, showing year-over-year inflation of 6.0%. Treasury yields for 10-year notes moved from 3.87% to 3.91% over the week. According to the Federal Reserve Economic Data, FRED, these movements were within the expected weekly volatility range and did not indicate extraordinary stress in fixed-income markets. Comparing to the prior month, silver's March performance represents a 2.1% increase from the February closing average of $70.75 per ounce. Historical data confirms that similar short-term fluctuations are typical for silver. Over the past 5 years, the standard deviation of monthly silver price changes has been approximately 7%. Forecast from the World Bank's Commodity Markets Outlook, March 2026 edition, suggests that if macroeconomic conditions remain unchanged, silver may average $72 to $75 per ounce in Q2 2026. This is a forecast, not a certainty, based on anticipated industrial demand and monetary trends. In summary, the recent weeks saw small, contained price movements in silver, steady open interest, and inflation-adjusted signals consistent with prior months. There is no confirmed disruption, no sudden shift in underlying market mechanics. When silver fluctuates, the effects ripple through both industrial and financial channels. Silver is not just an investment metal. It has significant industrial applications in electronics, photovoltaics, and medical equipment. According to the Silver Institute's 2025 annual report, approximately 55% of annual silver demand comes from industrial use. That means short-term price changes can alter production decisions, inventory management, and procurement strategies for manufacturers. Financially, silver acts as a hedge and a trading instrument. Investment funds, ETFs, and futures contracts hold significant quantities of silver to manage exposure to inflation and currency volatility. For example, holdings in the iShares Silver Trust, SLV, reached 980 million ounces as of February 2026, up 3% from January. Changes in silver prices directly affect these portfolios' mark-to-market values, influencing fund rebalancing, margin calls, and liquidity needs. First-order effects appear in industrial procurement and portfolio valuations. Companies purchasing silver for production face higher input costs if prices rise, and conversely, may delay purchases if prices fall. Investors tracking silver via ETFs or futures experience immediate account value adjustments. These are observable, measurable outcomes. Second-order effects manifest in broader market behavior. If industrial buyers delay purchases, supply chains may tighten or expand depending on inventory strategies, which can influence related commodities such as copper, platinum, and palladium. Similarly, fund rebalancing can affect liquidity in the futures market, altering spreads between COMEX and LBMA prices. Central banks, though not direct daily actors in silver, may adjust their overall precious metal strategies in response to trends that affect inflation hedges or reserve allocations. From a macro perspective, silver prices intersect with currency and monetary conditions. The US dollar index, DXY, often moves inversely with silver. During periods of dollar strength, silver tends to show moderate downward pressure. Treasury yields, inflation measures, CPI and PCE, and industrial output forecasts all feed into silver's price dynamics. For example, Fed data shows that a 1% change in real yields on 10-year treasuries historically corresponds to roughly a 0.6% movement in silver prices over a 2-week horizon. Understanding these interactions helps contextualize the short-term fluctuations as part of a systemic chain. Industrial demand, investor positioning, and macroeconomic variables interact, creating a web of cause and effect that is observable and trackable. No single price move occurs in isolation. The market is a network of interconnected levers, and the implications of a $1 to $3 move in silver ripple beyond the ticker, affecting production decisions, fund valuations, and cross-commodity strategies. Looking back, one of the closest parallels to current silver conditions comes from 2011 to 2013. Silver began 2011 under $30 per ounce, then surged to over $48 in April, before a sharp correction pushed it back down toward $30. At the time, many market participants assumed a new floor had formed at $30. It persisted briefly, only to fall below $20 in mid-2013 and remain in that lower range for several years. The similarity lies in pattern recognition, a rapid ascent followed by a temporary plateau, and market narratives building around an assumed price floor. Investors then, as now, responded to short-term peaks with expectations about where silver should stay. Yet there are notable differences. In 2011, global macro conditions included the aftermath of the 2008 financial crisis, European sovereign debt tensions, and different industrial demand patterns. Today, silver interacts with higher inflation, tighter monetary policy signals from the Federal Reserve, and modern ETF and futures markets that have grown in scale and sophistication. The dynamics of liquidity, leverage, and retail participation are not identical. Historical data confirms that short-term floors are rarely durable. Charts from LBMA and COMEX illustrate how the market adjusts to both supply-demand mismatches and sentiment-driven buying or selling. For example, while silver held above $30 for several months in 2011, it eventually moved lower without external shocks, a natural market correction rather than a sudden event. By comparing then and now, the takeaway is analytical rather than predictive. History shows that silver's price can temporarily stabilize, but this stabilization is fragile. Patterns repeat in structure, not in exact levels or timing. Recognizing the differences, monetary policy context, market structure, and industrial demand helps frame current fluctuations with perspective rather than fear. Investors can see that volatility is a structural feature of the silver market, not a signal of imminent collapse. This historical lens allows us to separate anecdote from data, confirming that short-term narratives around price floors have precedence, but each cycle exists within a unique economic and market environment. Bull case, conditions for continued strength. If industrial demand for silver maintains momentum, particularly from electronics and solar panel manufacturing, and if real yields on 10-year treasuries remain below expectations, silver could sustain or modestly increase in price. According to the World Bank Commodity Markets Outlook, March 2026, industrial demand could add 3 to 5% to annual silver consumption if technological adoption trends continue. If inflation expectations stabilize without triggering aggressive Federal Reserve rate hikes, then investment demand through ETFs and physical bullion may remain steady. Under these conditions, silver could hover between $72 to $75 per ounce over the next quarter. This scenario assumes no major disruptions in mining output or geopolitical supply chains. Base case, stabilization, within typical ranges. If macroeconomic and industrial factors hold steady, industrial demand matches supply growth, treasury yields fluctuate within historical volatility, and ETF positioning remains largely neutral, then silver is likely to continue moving within a typical $70 to $73 range. In this scenario, small daily swings occur, but no persistent directional trend develops. Volume and open interest remain consistent with recent averages, roughly 40 to 45,000 COMEX contracts per day, and open interest near 160,000 contracts. Historical precedent from 2015 to 2016 demonstrates that silver can stay range-bound for several months without external shocks. Market participants would likely adjust positions gradually rather than trigger abrupt price moves. Bear case, factors driving a downward trend. If real interest rates rise unexpectedly, industrial demand slows due to reduced manufacturing activity, or a significant number of leveraged positions unwind rapidly, silver could face downward pressure. For example, in 2013, when silver prices fell from $30 to below $20, the decline was influenced by reduced speculative demand combined with inventory adjustments and rising opportunity costs for investors. Similarly, if Treasury yields climb sharply or the US dollar strengthens beyond current levels, historical correlation suggests silver could weaken by several percent within weeks. This scenario does not require a crisis. Gradual macro shifts and portfolio reallocations alone could produce measurable downward movement. Each scenario is conditional, not predictive. Bull, base, and bear cases illustrate risk awareness, showing how industrial demand, monetary policy, and investor positioning interact to shape price outcomes. Importantly, these scenarios are derived from historical patterns and forecasts, not speculation or fear-based claims. For professional risk management, investors may consider position sizing aligned with volatility expectations, monitoring open interest and ETF holdings for shifts in investment demand, watching real yields and DXY fluctuations as leading indicators. This structured, probabilistic thinking allows market participants to anticipate possible outcomes while avoiding overconfidence in a single prediction. Silver's price moves as part of a complex system. Each scenario reflects plausible market mechanics grounded in data. When analyzing silver, I focus on a handful of measurable high-signal indicators. The first is the US dollar index, DXY. Historically, silver has an inverse relationship with the dollar. When the DXY rises sharply, silver tends to experience short-term pressure. When the dollar weakens, silver can gain. Monitoring daily and weekly DXY movements provides a context for interpreting price swings. Second, I track Treasury yields, particularly the 10-year and 2-year notes. Real yields, nominal yields minus CPI inflation, often influence precious metals demand. A rise in real yields increases the opportunity cost of holding non-yielding assets like silver. Conversely, stable or declining real yields tend to support investment interest in metals. Historical Fed data shows measurable correlations over 2-week periods. Inflation metrics come next. The Consumer Price Index, near CPI, and Personal Consumption Expenditures, PCE indices. These provide insight into purchasing power and market expectations. Inflation surprises, above or below consensus, can shift investor positioning in ETFs and futures. For example, minor deviations in CPI from forecasts have historically triggered intraday silver movements of 1 to 2%. Volume and liquidity in the COMEX silver market are also critical. Daily contract volumes, open interest, and bid-ask spreads reveal whether price moves are backed by genuine market participation or thin liquidity. Abnormal spikes in volume or sharp changes in open interest can indicate positioning shifts by institutional participants. Finally, I watch industrial demand and supply signals, mining production reports, ETF inflows/outflows, and global consumption forecasts from the Silver Institute or World Bank. Even small adjustments in production or inventory levels can ripple through prices, particularly when combined with macroeconomic data. By systematically tracking these indicators, I can identify when price action aligns with fundamentals, when it's temporary noise, and when a deeper trend may be emerging. This approach separates signal from hype, allowing a professional interpretation rather than reacting to social media narratives. It's about preparation, observation, and understanding interactions between currency, yields, inflation, and supply-demand fundamentals. Silver moves, always. The market doesn't pause because we have expectations or because headlines shout. What matters is understanding the mechanisms: industrial demand, monetary signals, and investment positioning. When you watch the indicators, you see patterns, not promises. Volatility is not failure. Temporary dips are part of the system, not signals to panic. Long-term perspective matters more than short-term noise. Historical data and reputable forecasts show that silver interacts with multiple forces simultaneously. One factor alone rarely dictates its path. For professional risk management, position sizing, monitoring key indicators, and maintaining cash reserves for flexibility are essential. Investing with discipline, patience, and clarity about objectives reduces the impact of unexpected moves. This isn't investment advice. It's how I'm reading the market right now. Systematic, measured, and focused on facts and forecasts, not fear, not hype. Patience and observation remain the most reliable tools in navigating precious metals markets.